Welcome to College Smart Radio, helping you bring into focus the true cost of college and how to tackle the runaway cost of financing a college education. College Smart Radio is hosted by Beatrice Schultz, a certified financial planner and founder of Westface College Planning. Now, here's your host for College Smart Radio, Beatrice Schultz.
Getting a top-rate education in this country is extremely expensive, and it's getting worse every year. In order to afford an education, many people rely on saving and taking advantage of scholarships and other savings programs. However, there is another way to save for college that's not always on the top of mind for parents or students: tax breaks. On today's College Smart Radio program, I have a self-described tax nerd as my guest. We will be discussing ways to maximize tax savings in each stage of the college funding and loan payback process. Hi, I'm Beatrice Schultz. Welcome to our weekly show, College Smart Radio, where we help you tackle the runaway costs of a college education. Our show is all about bringing up-to-date and practical advice to parents who are dealing with the cost of a college education for their kids. With some private schools costing over $60,000 a year, a UC costing close to $35,000, and a California State University running $25,000, parents need more help than ever. We bring you that help by sharing ways to pay less, tapping into financial aid, and prioritizing your source of funds to make sure you get through the most expensive years of your life. Based on my own education and experience, I share my insights with you week in and week out. And I bring in experts in many areas of the college process, from counselors, financial aid officers, student coaches, parents, and even students. You'll learn firsthand the ins and outs of how to pay for college and survive financially. In addition to our show, you can find lots of powerful information at our website, collegesmartradio.com. We have many articles that I've authored with up-to-date information on navigating the waters of paying for the runaway costs of college. We have a monthly e-newsletter full of content about college planning. We also have posted a glossary of key terms used in the world of college planning, terms like total cost of attendance, FAFSA, net price calculator, and so forth. And we have a link to our free community parent workshops and webinars that I host to teach parents about how to pay for college and how the financial aid system really works. Let's get into today's show. As we're learning strategies to spend less on college, tax breaks are one area we look to and want to understand. There are several tax breaks available to make college and continuing education more affordable. The tax savings you should be thinking about will differ depending on what stage of the education process you're in now. Are you planning for your education? Are you receiving it now, or are you paying for it after already being educated? My guest on today's College Smart Radio program is Mitch Fox, the co-founder and chief operating officer of GoodApril, an online tax planning startup based in San Francisco. GoodApril is currently participating in the prestigious TechStars Startup Accelerator program in Boulder, Colorado, which will culminate in an investor demo day next month. Mitch has over 4 years of experience as a financial technology marketer and product manager, most recently serving as director of product management at Endurance Lending Network, a small business lending platform. Previously, Mitch was director of marketing at Zico, an online brokerage, and was a management consulting at Bain & Company and the Monitor Group in San Francisco, Sydney, and London. He received a BA in International Business from Georgetown University in Washington, D.C. Mitch is joining us today via phone from Boulder, Colorado, from the TechStars conference. Hi, Mitch. Welcome to College Smart Radio.
Hi, Beatrice. It's a pleasure to be here today.
Thanks so much for joining us. Let's start by sharing a little bit about you and how and why you started GoodApril.
Yeah. So when it comes to filing your taxes, it's really hard to have a GoodApril. And my co-founder and I saw an opportunity to make things a little bit easier for taxpayers. Two of the ways that taxes are so hard are that outcomes are not known in advance. You don't know if you're going to get a refund or if you're going to owe the government until you actually come to the day that you're filing your taxes. And you don't know if there were things you could have done during the course of the year to pay less in taxes. And in particular, that side of things is part of why we're talking today. Our particular company is working on a solution which takes advantage of a technology called financial data aggregation It's a tool that most people are familiar with from another company called Mint.com. It's a way for people to connect up their bank accounts to an online website and to pull all that data together into one place. Mint uses that to tell you what your account balance is and how your spending patterns are changing. We use that data to create a tax forecast for you and to identify savings opportunities that are relevant to your situation. So today we're going to be talking about education tax breaks for students and parents, and those are exactly the kinds of savings opportunities that our platform can identify for you, and to make it clear which of those opportunities relate to you and bring those front and center and help you ignore all of the other ones that don't. Because as most people know, when it comes to taxes, a lot depends on your personal situation, how much income you make, if you have dependent children or not, etc.
GoodApril, I love that name. I didn't realize that was the reason for it, and I agree. In the college planning arena, it would be a good April or a good year if you know ahead of time even how much you're going to pay. And I talk a lot about those putting together a college funding plan, and part of that plan is if you're going to get a tax credit or a tax break, you can take that into account when you're figuring out how much this year's or next year's tax bill is going to be. So that's really valuable. And just one more question on the kind of the technology that you've got there, Mitch. So would it be, you mentioned Mint, would this be something that you would kind of partner with someone who puts their data into Mint that they can also then kind of get a push that would be, hey, this is what your tax picture is, or would it be completely separate and you just use Mint as an example of a place where you would collect data?
So I use it as an example partially because the foundational technology, this data aggregation service, is actually something that is available for other companies to use. So we can license that same basic underlying technology, and that's what we're building off of right now. What we would love to do down the road is to be able to partner with Mint and with other online personal accounting and small business accounting products in order to pull in data that you may already be collecting from those places. But we do expect to be able to support someone who's not using any of those tools today and is just going to use GoodApril on its own.
Okay, well, let's talk a little bit about your tax nerd status and start talking and let's discuss a little bit about the college tax savings. Kind of when do you start thinking about taxes when you're thinking about saving for college?
Yeah, so as you pointed out at the top of the show, there are really these three different phases. There are things to think about before you actually go to college or before you send your kids to college, things to worry about while you're actually getting that education, and then after. The place that most people start thinking about it is in how to save for college, and in particular, there are types of savings plans called 529 plans that are really the most popular way for parents to save money for education and to do it in a tax-advantaged way. You can think of a 529 plan as being similar to a retirement savings account, an IRA, except for that where you're getting the tax advantage is instead of using that money for retirement, as long as that money is being used for educational purposes, you can withdraw the money tax-free and save money on basically not having to pay any capital gains, any growth that has occurred on those savings during the time that you had it invested.
529 plans, if you're a California resident, there's no benefit when you actually contribute the money to the 529, but some of our listeners are from outside of California, where in some states there could actually be even a short-term planning tool in the sense that you sometimes will get a tax break on the money that's donated in a couple of states still, I think. I know not in California.
Yeah, and some states will, for instance, provide advantages to residents that are contributing to a 529 plan. For instance, matching or providing breaks on in-state tuition for people that have saved in their state's 529 plan.
Okay, so 529 plans are going to be the college saving, or that would be a vehicle where you're going to be taking tax savings into account. And part of that being that when it comes time to pay for college, you're not going to have to pay tax to pull that money out of whatever investment it may be in, and you will have taken advantage of that deferred growth or that collection of growth along the way as long as you withdraw and use the money for college. And in fact, for parents, they can use the money for the specific student or for siblings, or you can really use the money for anyone in your family. Is that correct as far as the rules go, Mitch? How wide does it range?
Yeah. So it's important that, as you said, that those expenses be used for qualified education purposes, and those are well articulated and defined by the IRS and by the different state plans. One of the only things that people need to sort of keep track of is the amount that they're contributing to those plans on any annual basis, because you can find yourself with encountering problems with a gift tax if you contribute too much in any given year to those plans.
Yeah, and unfortunately, it's tough for many families to come up with the $14,000 a year per parent that they could contribute for the 529. But it is true that it's good to understand there are limitations. But the limitations for these specific, like you have this, I think in California or some states, the limit's as high as $300,000 that you can put in a 529. So you absolutely could save enough for college if it makes sense for you for your kind of financial planning. If that makes sense for you as far as your family and what your college plans are. Mitch, we're gonna take a break right now. And when we come back, I'd like to talk about we'll go on and talk about what kind of tax breaks there are during college and post-college. You're with us on College Smart Radio, where my guest today is Mitch Fox, a tax nerd and co-founder of GoodApril, an online tax planning service. Mitch and I have been discussing tax breaks available, and we'll be talking about tax breaks available at every stage of the college and loan payback process. We'll be right back after a quick break.
For more information on today's topic, visit collegesmartradio.com. or call area code 650-587-1559. College Smart Radio continues in moments on AM 1220 KDOW. Contact Beatrice Schultz at collegesmartradio.com or call area code 650-587-1559. Now, back to College Smart Radio with your host, Beatrice Schultz, on AM 1220 KDOW.
Welcome back to College Smart Radio, where we help you tackle the runaway costs of college. I'm Beatrice Schultz. We all know that college is expensive and will most likely be some of the most costly years for a family. Understanding how to navigate the college costs is a smart thing to know. To help families be on this radio show, I host community workshops live and via webinar several times a month that explain the costs of various colleges, how the financial aid system works, and things to consider to prepare yourself for this tremendous expense. To learn more and reserve your seat, go to my website at collegesmartradio.com. If you've just joined us, I've been talking with my guest, Mitch Fox, a tax nerd, about education tax saving strategies. Mitch, we were just talking about the different stages and the different tax breaks, and we started with the pre-college stage. Let's talk a little bit about what tax breaks are available during college years.
Yeah, absolutely. So a few things to talk about here. First, there are really three big opportunities that can apply to a person. Each of the three can be more applicable in different situations, and it's important to note just that there's no double dipping, basically, amongst those three. You've got to choose one. The other thing worth spending a moment talking about is really who gets the benefit, and I guess I'll actually start there. For students, in many cases, you actually won't receive, you won't be able to take advantage of these savings opportunities because in many cases you're still the dependent of your parents. And so for parents, the thing to keep in mind is that if you're claiming your child, or if you can claim your child as a dependent, it's really up to you to be able to take advantage of these savings. But they do have a limit on income. So each of them has a income test where if you earn over a certain limit, you can't take advantage of them. But for many parents, these are very valuable savings. So those three are the American Opportunity Credit, the Lifetime Learning Credit, and the tuition and fees deduction. And we can talk a little bit about each of those three.
Hey, Mitch, let me mention or maybe confirm with you one more point, which is you also can't double dip and use 529 money and also take advantage of one of these tax credits. Correct?
No, that's actually a interesting point. I'm actually not sure about how that interplay occurs. It sounds like you've seen that in the past, however, correct?
I've had other CPAs that have told me that, so I didn't mean to put you on the spot, but it's a good question for me to check into, so I thought I would check with you because some parents have questioned it. Their accountants have allowed it to go. So I just was wondering if you had any expertise in that, or if you were sure. It sounds like you haven't run into that yet or haven't seen that happen, so I didn't mean to put you on the spot. It sounds like that's maybe not so clear of a rule. But go ahead with the three options that are available during college.
Yeah, absolutely. So the first, the American Opportunity Credit, generally speaking, would be the best credit that most people could get. It has some limitations. You need to be in the first 4 years of an undergraduate education, or your son or daughter does. What's great about it is that it's a $2,500 annual refundable credit, and in the world of taxes, credits and deductions are sometimes confusing. Credits are particularly valuable because they can dollar for dollar reduce the amount of tax that you're paying at the end of the year. And what's great about this one, since it's refundable, that means that even if you didn't owe $2,500 in taxes, you would actually get whatever extra is left over after you use part of the credit as a refund. So it's particularly valuable.
So most valuable for families with kids, or for the students that are in the first year of college and the family either as a joint income tax return makes less than $180,000 or as a single makes less than $90,000.
Yep, exactly.
Okay.
The next one typically to look at is the Lifetime Learning Credit. What's really nice about Lifetime Learning is that you can use it every year. It can be used for undergraduate, graduate, or continuing education. And so if, for instance, your son or daughter has exceeded the first 4 years of their undergraduate education, you can continue to use Lifetime Learning Credit. It's a $2,000 annual credit, and it's non-refundable, so it doesn't have quite as much kick, I guess, as the American Opportunity, but it's still a very powerful saving tool for parents.
And if families have 3 kids that are in college and maybe 2 of them are in their first 4 years and then the third one is in his 5th year, would they be able to take advantage of a credit for each of the kids?
That's my understanding.
Okay, that's my understanding too. I assumed that you'd be able to kind of pick one for every kid.
That sounds right to me.
Okay.
The last for us to talk about is the tuition deduction. So the way this one works, you are able to take $4,000 of a reduction in your income. So deductions, unlike credits, they reduce the amount of taxable income that you have. So the value of each one of those dollars is a little bit less powerful, but it doesn't have that same restriction on it being for the first 4 years of undergraduate education. So it can tend to be a little bit more flexible than the American Opportunity Credit, and the income limits on it are a bit higher than the Lifetime Learning Credit.
Okay, well, what about what's available for I guess post-college? What kind of deductions are available when you're trying to pay back college loans, or what other educational tax credits are out there?
Yeah, so 2 that I think are worth thinking about. The first is the student loan interest deduction. So if you or your son or daughter are paying back student loans, the portion of those payments that is going to pay back interest is deductible from your income. And so that's for up to $2,500 per year. And what is, this has the same kinds of income limits on it as some of these other deductions. But, hopefully you're not paying a tremendous amount of interest on those student loans. But if you are, there is at least a little bit of a break there.
Okay, and is it only the student that can take the deduction for the interest on their student loans? Or if mom and dad are paying back the loans for the student, even though they're in the student's name, could they take the deduction, or would they want to?
No, so yes to the first part, no to the second.
Okay.
So if the loan is in your name, you can take the deduction. So if the loan is in the parent's name, the parents can take the deduction. The loan is in the student's name, the student takes the deduction. It's who has the responsibility or the obligation to repay that loan. So there is definitely an opportunity to take that deduction, either as a student or parent. It just depends on whose name it is.
Okay, I often recommend to families to start with all the loans that are available in the student's name, because it's also very more likely that the student's going to qualify at the income level than some families, if I know that the families are making more than that interest level. And there are some other reasons why student loans are good. Okay, anything else for the post-college student? Any other tax break?
Yeah, one just to keep in mind is that there is a deduction available to help pay for moving expenses when you're moving through a new job. So if you've just graduated and you're moving more than 50 miles to start your job, that move is deductible. So just keep in mind to keep track of your receipts and expenses related to that move so that you can claim it on your tax return at the end of the year.
And one of the other tax advantages, if you're self-employed and you're taking courses and maybe you don't qualify for the tuition deduction, but you would still be able to take that as a business expense on your tax return to get a break?
Yeah, in fact, it's probably one of the most powerful ways to be able to get a tax break on education. If you are self-employed and you are taking courses that relate directly to your profession, a good example for people in Silicon Valley, say you're an iPhone developer and you wanted to take some additional courses, for instance, to become a web developer, you can do that and claim those education expenses as a business expense to offset your income. And there's really no limit on the amount of that you can take as long as you're offsetting business income. So can be a very substantial savings opportunity for a self-employed person.
Yeah, those are really great tax tips. Mitch, I really appreciate you sharing them with us. And I think it's important for our listeners to kind of understand there's all these different stages and that there's going to be tax advantages along the way. Mitch, before we leave the show, do you want to just take a couple minutes, talk a little bit about your GoodApril website and how some of our listeners can take advantage of your tax checkup?
Yeah, absolutely. So our website is GoodApril.com, all one word. And the tax checkup, it's a very easy-to-use tool. Basically what we do is someone can come to our site, complete a very simple profile, just 3 questions, if you're married, if you have kids, and what your income is, and then upload your most recent year's tax return. We pull the data out of that return and are then able to generate a report for you. Think of it as a report card for your taxes. And it highlights 2 big things. One is how much more are you going to owe in taxes if your income and financial situation are the same year to year from last year? How much more are you going to owe this year as a result of tax law changes that are coming into effect? And so, for instance, Obamacare, the Affordable Care Act, and the fiscal cliff deal both include a number of new tax laws that can impact people. So we're helping you understand exactly which of those rules affect you and by how much, so you can be prepared in advance.
Hey, thanks so much. Hey, Mitch, I'm sorry I got to cut you off. We got to cut off the show, but I'm going to have a link to Mitch's GoodApril website and that free 2013 tax checkup on my website, collegesmartradio.com. Mitch, thanks so much for joining us today on College Smart Radio.
Thank you. It was a pleasure.
Thanks for being there. Well, that wraps up another weekly show of College Smart Radio. We hope you picked up some new information today that helps you figure out ways to manage the runaway cost of college. This is Beatrice Schultz. Thanks for tuning in to College Smart Radio. We look forward to sharing more helpful information with you next week.
You've been listening to College Smart Radio with certified financial planner Beatrice Schultz. If you have questions on today's topic, log on to collegesmartradio.com or call area code 650-587-1559. That's 650-587-1559. Join us next week at this time for another edition of College Smart Radio on AM 1220 KDOW.